Darryl Gobbett, Chief Economist, with an update on the Reserve Bank rate cut yesterday and the release of the national accounts for the Australian economy this morning. The Reserve Bank reduced the cash rate by 0.25% to 3%. Markets have reacted quite positively to the news, and we're seeing the cash futures market implying around another 0.5% cut over the next sort of 6 or 7 months, so to bring the cash rate to in the order of 2.5%. National Australia Bank has reacted already, brought their variable rate down by 0.2%. The fixed rate home loans, though, the 3-year ones, are actually still sitting around about 5.4%, so not a lot of movement there. Term deposit rates have yet to move, although I think the Reserve Bank will be talking to the banks about getting both the term deposit rates and the home loan interest rates down, because that will actually then start to see the benefits of the cash rate starting to move through. But I think the banks are holding off on cutting their loan rates because they want to see a further fall in their cost of funds, and most of the money they've raised over the last couple of years has really been in term deposits. What we're seeing, the impact in the share market, is people are continuing, I think, now to move towards those higher yielding stocks such as Telstra, the banks. We're also seeing, I think, further moves into some of the higher yielding utilities, infrastructure stocks such as the airports and the gas utilities, as people are chasing yield. I don't think people are yet saying we're going into the markets in order for capital growth. I think really what they're looking for is cash flow and yield. The national accounts data came out this morning sort of about on par. The expectation was about 0.6% growth in the September quarter, came in at 0.5% for growth of about 3.1% over the year, and that's after inflation. The components sort of show that the mining sector is slowing down further. Still very strong, but it's starting to slow down. We're seeing a bit of growth in the household spending, retail sales. One of the disappointing parts, though, is that the residential housing activity is really not yet picking up, and I think that's an area which the Reserve Bank would like to see move a bit faster. But again, it's going to be an issue of what's happening with land prices, because I think that's often an area where people look at in terms of the overall cost of housing. So overall, I think this sort of continues to give our share market pretty good support, but it's probably going to be mainly in those higher income stocks as people start to believe that they're going to have to move into those types of investments as term deposit interest rates fall further in the new year. Thank you.